There we go. I'm Oliver Renick. We are live from the Money Show in Las Vegas. Thanks for tuning in. Chicago is on the move. Never turned down an opportunity to come to sunny Nevada, where things are kind of popping here at the Paris Hotel, where the Money Show is going off. We got sponsors from oil to Bitcoin to AI. We've got some great technical minds. We've got ETF people. We just heard Dan Ives speak about AI. I gotta say, I think for my quick spiel about where we're at in the market right now, the overall situation seems to be one that's pretty stable. Stocks have firmed up again today. You see equities that are generally holding on for the ride. The chart for the S&P 500 remains pretty range bound. The VIX, though, still trending higher, but we haven't had any major blow up at all. The S&P 500 still sitting in a range, which looks pretty good right now. We're just basically going back and forth between the 200-point levels, roughly 7,000 above, 6,800 below. And the other thing I'd say is this morning, I always like to make a habit of watching cable when I'm on the move in the hotel. And the CNBC coverage this morning, I gotta say, love you guys, but the headlines drip with horror. Beware, beware, beware. I'm not sure what the fear is about. There's a lot of very breathless talk about AI, the disruption, problematic disruption. Maybe it's because crypto's getting pummeled. The chart for BTC obviously is one of the worst out there. Today, again, sluggish, even as stocks firm up. And by the way, my luck remains pretty good in Vegas with the coiners. It's the strategy conference in my hotel at the Encore. So I did try and drop by and say hello to a few of the coiners there to support Michael Saylor strategy and the struggle that is that stock, which is today still holding on to 120 bucks, but it's been, of course, a pretty rough ride. Got a very good show coming up here from the Money Show. We're going to be talking with Nancy Tengler. We've got Sam Moreau. We've got Jeff Hirsch. We've got Jay Soloff. I'm getting ready for a presentation this afternoon at 5:45 p.m. If you're in Vegas, come through. We'll be talking about options with Matt Fox from Spot Gamma. So there's a lot of good stuff going on. There's a lot of creativity, I think, in the air right now about how to diversify your portfolio, and a lot of people here have different answers to that. We're going to start by talking about some good old-fashioned stock picking with strategists. It's been one of my favorites for a long time and does run a SIBO-listed ETF. So as the exchange-traded profile of the day, perhaps the Vegas version, I'm joined here by Nancy Tengler, which I think is very fun to see you, Nancy, and to have you here because you guys and I think the traditional stock picker is kind of underappreciated in the world today to some extent.
Yeah.
Your fund TGLR had a great year last year.
Yeah.
Tell me about what you guys are doing.
Yeah. So we're growth. Thank you for that. And you said Nevada correctly.
Yeah. Oh, you're okay.
I live in Nevada.
Sometimes my soft A's come out, but
Not
usually
Nevada.
yeah.
It's Nevada.
Uh-huh.
Anyway, yeah. So we are growth at a reasonable price, sort of value investors. And that allows us to buy fallen angel growth stocks. And so the portfolio has dramatically outperformed the Russell 1000 value since inception. And then also I have a longer term track record in this strategy outside of the ETF. But last year we not only outperformed the Russell, we outperformed the S&P, and we're outperforming the S&P again this year. So it's taking our investment theme, which is old economy companies that have pivoted to the new technologies. Think Walmart. That worked out splendidly.
Great stock, by the way, right now.
Yeah, and we've owned it for about 10 years, but we really doubled down on our holdings when we realized they were investing in technology, and now they're a NASDAQ listed company and a member of the NASDAQ 100. But
So tech in kind of unexpected places, perhaps?
yeah, that's a great way of saying it. Deere is another that we added under that theme in old economy. And then we own Broadcom and we own Google in this portfolio. We own Microsoft and a number of the names that are driving the underlying AI story. And I think there's some real opportunities right now with names like Microsoft to add to.
Okay, hold that. I want to get to that though. Hold that thought about the Mag 7 stuff because I've got Deere up right now. Through your chart, really exploded the last couple of weeks. Sam Rowe, who's standing by, was just telling me about the kind of shift of productivity and margins that are happening, where you've got the big tech companies that are investing, they're spending capex for the first time, and a lot of these other businesses that I think we kind of called maybe old world businesses to some extent, maybe are largely the beneficiaries of some of these, new technologies. Where I think almost, he's going to give a chart for us that the mentions of AI having a positive impact on their companies is That's Deere, that's Walmart, right?
Yeah, no, 100%. And we're seeing it, we sit on all the earnings calls. We're seeing it across industries. So you've got companies like American Express that are improving marketing and fraud detection by over 90% using AI.
Wow.
And then you've got supply chain management coming from Raytheon, or RTX, which is one of the holdings in TGLR. And that is benefiting. I mean, I think they reduced old inventories by like aged inventory, sorry, by like 50% last year, and they're improving supply chain movement and rapidity of movement. So that's exciting, and we're seeing it in every single sector, in healthcare, in all of the industrial space in particular, and then there are some other spillovers like in REITs, when we own PLD, and there's Equinix, which is also a beneficiary. So
the idea of kind of having a broadened out portfolio finally is really paying off.
yeah, yeah,
And I guess that can last. We've got so used to this hyper concentrated market, but the S&P chart has now gone sideways essentially since November
yeah,
of last year.
yep,
And again, your fund in the last year up 22%,
yeah,
52 weeks. For the S&P 500, you're up about 15%. So that kind of stock picking ability should work better in markets that are a little bit less concentrated, I would think, because the concentrated market is kind of like just ride the index,
yeah.
basically, right?
And this is a dividend growth strategy. So we do, I mean, we
Okay.
look at the dividend as a proxy for management and the board and what they think about future earnings power. So you saw Walmart dramatically accelerate the dividend about 2 years ago, and that's because they were very optimistic about future earnings. Wall Street's wrong 2/3 of the time, Oliver. So on earnings numbers. So we want to hear from the people that matter, and that's the people running the company. So we're precluded from owning the no dividend payers.
Okay.
So Google was a bit of a draw. I mean, it's a low yielding stock, but they started paying a dividend, and they were, we believe they're going to grow it. So
How big is the dividend angle right now when you're talking to potential advisors who want this for their clients, or just anybody who is kind of thinking about income? Because I feel like also one fairly consistent theme across all kinds of asset classes, whether it's options, whether it's,
yeah.
people want income of some form, I feel like at
Yes.
this point.
Yeah, so this is a dividend growth strategy as opposed to a high yield strategy. So
Okay.
the yield is about 1.8, 1.9%, but it's been growing at 12.5%, almost 13%. Sorry, almost 13 over the last 5 years annualized. So that's powerful because it's a great hedge against inflation, even the high inflation we had in 2023.
Okay, back to yeah, back to Microsoft.
Yeah,
Because this is where I do feel, the kind of rubber meets the road a little bit, because the cloud sell-off that's been really nasty,
yeah,
has brought down some giants, and I think Microsoft is the biggest one.
yeah.
Like a
Sure.
lot of these cloud companies,
Maybe
the
Amazon.
mid cap,
Yeah,
Amazon too. But
Yeah.
I mean, the chart for Microsoft is so nasty.
it is.
You want to buy it here at 388?
Yeah, we just added to it. I think at the end of the day, Microsoft will be a winner with expanded margins. I mean, they understand AI better than the old economy companies that we're buying. They will pivot. Satya Nadella is a pivoter. He will pivot. The Copilot's been a kind of a big disappointment, and I think enterprise users are not adopting it as quickly as they need to be.
I've got it on the computer here, and I don't think I've used it once, to be honest. I've used AI from everybody else.
Yeah, I love Grok.
Grok,
personally, but
Grok is great and entertaining. Gemini is fantastic.
absolutely.
Google works really well for me. So when you think about that, they're probably going to fix it at some point. I mean,
They are.
think about Amazon. Alexa stunk for
Yeah.
a long time. And I used to joke about on the show, like, last year, maybe 2 years ago, I was like, why is Alexa still so far behind? And somewhere about like 3-4 months ago, Alexa started getting pretty good
Right.
again.
Well, and remember, we left Google for dead a year and a half ago.
Uh-huh.
So that's when we added it to the value strategy. We owned it in growth forever, and we're up like 130% in the name or more. So they have cash. Microsoft's got 89 billion on the balance sheet in cash, and they will make the adjustment. I mean, just as you argue Amazon did,
Yeah.
and I think that's why you want to own the industry leaders. Now we got out of Adobe. I was getting all sorts of questions about Tesla's Elon Musk's pay package
Uh-huh.
and how egregious it was. Well, the Adobe CEO, the stock's down 32% cumulatively over the last 5 years, and he got paid $220 million. So you tell
That's
me,
egregious. Yeah.
that's
And by the way,
right,
that one felt like the writing was on the wall as soon as AI came out. Anybody that's ever used
100%,
Photoshop, Premiere, Creative
100%.
Suite, it was like as soon as you saw what you could do, it was like that stock's in trouble.
Yeah.
And they were,
And they did not pivot, and they did not
and they got run
monetize.
over.
Yeah. And so we got
So
out.
you think Microsoft though will make that?
I
Will
do.
wake up?
I do.
Okay.
I think they're in process of doing so, just from what I can tell, in our research. So I think that's a name, and it's a dividend grower, believe it
Yeah.
or not. And so that's a name I think you want to add to down here.
Great stuff.
Yeah.
TGLR is the fun.
Thank you.
Appreciate it, Nancy. Great
Thanks,
to catch
Oliver.
up. Yeah,
Yeah.
good stock picks and great year for TGLR.
Thank
We're going
you.
to take a short 2-minute innovator break. Then I got the great Sam Rowe from TK joining us right here in a moment from Vegas. 2 minutes. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Renick. We are here in Las Vegas. We're going to talk about how stocks usually go up, but sometimes it gets a little complicated. Lately, they've been going very sideways. I'm joined by Sam Rowe, author of TKer.co, TKER.co. Here with me in Vegas, getting ready for a speech. And I think the context for this, Sam, that's pretty good, is I'm going to pull up the chart of the S&P 500, which is basically going sideways. It's been stuck. But you obviously in TK have written a good bit about how things usually for the equity market are pretty reliable to go up. I feel like I've come more and more to appreciate your kind of theme of your newsletter as well over the last kind of maybe 4 or 5 years, because the concentrated market was sort of a testament to why you generally just kind of park your money in stocks.
Sure.
Great to see you, man.
Thanks for having me.
Absolutely. Tell me firstly, kind of so far this year, what's your read on this kind of grind that we've got? What Nancy and I were just talking about, which is I think people are worried that we're going to lose the generals. We've lost a lot of other sectors, cloud mostly, crypto's getting obliterated, and the mags are just kind of like holding on for the ride.
Yeah, I mean, it's possible. Maybe next week it turns out that we were wrong to be worried and everything goes back on track. But that's actually a really great analogy. Maybe we're losing the generals. I mean, if we, like, even in real life, right, in the military, the generals don't live forever, but the army has been around for 250 years,
Yeah.
right? And the military keeps getting bigger or whatever. And politics set aside, that's an incredible analogy, right? the generals from 200 years ago aren't alive today.
Right.
They eventually retire, fall out, and someone else rises up. And that's exactly what happens in the stock market all the time.
Yeah, that's fair. You've done two, I think, really good pieces in the last couple months
Yep.
about the AI kind of transfer of valuation. One way that I described it is we're kind of just transferring valuation from cloud companies to hardware because now the hardware is proving to be more productive.
Yeah, it's definitely possible. There's it's kind of crazy. You can almost back into any sort of narrative you want um, when everything's changing,
Yeah.
right? Because so many things can make sense all at the same time. But yeah, for one thing that seems pretty clear is at least from a software standpoint, or at least from a white collar worker standpoint, or at least from like a programmer engineer standpoint, all these AI tools that we're learning about, or that we've been learning about over the last 3 years, and arguably maybe even further back than that, has made people that much more productive, or it's replacing so many tasks that used to bog us down. And so whoever is going to benefit from that, whether it's a business or an industry, or the way a show is produced or whatever, are going to see that in the form of better margins.
Yes, the margin part's really important because this technology that's going through every sector is going to help their margins. That's kind of the idea is like they should be able to lay people off. They should be able to flatten overlap, which I think is a lot of what the cloud sector went through because, post the COVID kind of cloud correction was a lot of combinations, a lot of M&A. I think there was a lot of fat left over. They kind of had to trim it up.
Yeah, it's possible. I mean, we haven't really heard a whole there's anecdotes out there about layoffs, but when you look at the data at the national level, layoff activity has been actually pretty steady. So there's a case to be made that maybe we're just going to get more out of the existing workforce. But I think this is actually probably one of the more, if not the most important story that we're going to have to be following for the next 3 to 5 years. Because it's not as simple as saying, hey, AI is going to make my business and my industry more profitable, right? Because all the people who are selling you this stuff, like the hyperscalers and the AI tool developers or whatever, they're all effectively giving this stuff out for free because they want you to believe and recognize how much this makes your jobs easier. And so, maybe a couple of years down the road, after you've overhauled your entire business infrastructure or your operations, and you're plugged into these AI tools, and you have 500 basis points of profit margin gains, maybe they turn around and say, hey, the price is going up.
Right. Yeah.
And you have nothing, you can't separate yourself from that because it's already part of your business model. If it actually hurts profitability, by too much, and maybe you switch products and go back to the old school ways of having people, but that's not how it's going to work, right?
Yeah.
They're going to tell you, they're going to see that you're saving $50 million a year. They're going to tell you, you know what, we're increasing the bill by 25 million, you're still saving 25 million. And maybe that's how the service providers end up, making some of this money back.
A few charts from a article you just wrote. One is the manufacturing PMI. I've been talking about this a lot. ISM's over 50 in both categories, which does seem like a very good thing.
Sure.
Again, I don't know what it is about this particular moment. Maybe just because there's a lot of change that a lot of the news flow I'm hearing spins very negative.
Yep.
And I've never been one in my coverage of markets to shy away from trying to tell people what could be negative.
Right.
But I feel that the way I see things right now is a pretty big disconnect. We are less than 2% off the all-time highs.
Yeah.
And it's like horror in the headlines. We got ISMs in manufacturing above 50.
Yeah, I mean, there's a lot to be said about uncertainty, especially when it comes to things like volatile trade policy. Especially companies that do a lot of importing have no idea what the cost of the stuff that they're importing is going to be. Going beyond stuff like inflation, because they're still sort of figuring out what tariffs are going to cost on all this stuff. So all that stuff becomes a headache for the business managers and the executives and planners and all this stuff. So of course they're going to respond to ISM surveys and whatever and say, we're really concerned about this stuff, and NFIB surveys and everything else. But when it comes to some of the more tangible measures of the surveys, or if you go to some of the hard data stuff like durable goods orders and core capex and orders and stuff like that, all that stuff is holding up. And if anything, we're actually seeing some of that stuff improve. this year because
Continued claims, by the way, from your chart,
yeah,
flat, you know,
flat. You know,
initial
there have been
claims.
some movements, but it's mostly at levels. It's been trending at levels that's associated with economic expansion. Because I mean, a lot of things can explain that. I think the most important thing being that, you know, over the last 5 or 6 years, you know, in that post-pandemic world, everybody cleaned up their balance sheets. You know,
Yes, yep.
everyone from households and individuals all the way to the corporate world refinancing debt at low interest rates and stuff like this. So they have a lot of financial capacity, and if you have a lot of financial flexibility and your balance sheets are strong, then you're gonna operate like you're growing. So the hard data is saying that the economy is actually doing okay.
Yeah. Chart here, more firms reporting AI-driven return on investment ROI. That's pretty encouraging, I think. Also, to kind of Nancy's point about diversifying away from the concentrated market into specific stock picks that, even staples categories, manufacturing, all kinds of stuff.
Yeah, it's interesting. Over the last couple of years, there have been all these different surveys and studies coming out, trying to measure if businesses are actually seeing gains from deploying AI. And so much of it has been pretty inconsistent. And a lot of these surveys end up becoming kind of these black boxes. But this was a really interesting study done by Sparkline Capital and Kai Wu, the analyst there, who actually went into the earnings transcripts and the earnings calls for tangible language that is associated with tangible gains in AI. It's not as, beyond companies saying, hey, AI is helping our margins. They're actually going out and saying, hey, we rolled out a new thing for our procurement system and brought down our costs by 30%.
Yeah.
Or
this is not like expectations or prognosis. No, this is like product, service that's already showing up.
Yeah, it's already being delivered. So the quantifiable, tangible benefits, the number of companies that are reporting this is actually on the rise. So that's a good sign. I think generally speaking, the numbers are still relatively low. Like, you want to see, 50% of companies saying it instead of 10%, but directionally, more and more companies are actually saying, hey, we're saving money by using these tools.
Yeah, going up and to the right.
Up and to the right.
We
love up and to the right.
We love up and to the right, baby. That could have been the alternative title to your newsletter, Up and to the Right. Okay, tell me about this piece that you just put up that is fairly complicated. Okay,
sure. Yep.
So I think we need kind of like the top level version, and it'll also, I think, people should go and if they're not already on your newsletter, they're going to have to give this some time to read it. So go sign up and check it out. But this is essentially an accounting, a forensic kind of accounting analysis that you've done, or it's based on a research report about how the CapEx that we're seeing right now from these outlays by big tech companies will depreciate, right? And they kind of amortize out their expenses over time.
Right,
What's the point of this?
So, every day we open the newspaper or turn on the TV and someone is telling you about how the AI hyperscalers are committing 600 billion plus to building out data centers and whatnot. And, sometimes they'll say, oh, well, this is going to eat up free cash flow. And then everyone freaks out. And then, what are we supposed to do to that?
We can't buy back stocks anymore?
There's that too.
By the way, is that like, sorry, but is that, because that's a big one real quick.
Of course.
Are they sacrificing the buybacks?
Well, yeah. I mean, the cash comes from somewhere. If you're not, if all of your free cash flow is going toward capital investments, then there's less cash for buying back stock. But maybe that's a good thing because it's funny. There's nothing companies can do that won't welcome some sort of criticism.
I was just thinking that, right?
Yeah, for the last 10, 20, for God knows how long, all you hear about is, oh, companies are doing financial engineering by buying back stock.
None of it counts. It's just buybacks.
Now
right?
now they take some of that money and invest in CapEx. It's like, oh my God, it's reckless
too much
investment.
On CapEx,
But it's like with CapEx, you're actually buying stuff and putting people to work to build these data centers. So it's like there's something tangible to gain from that.
Now, that being said, though, there was always the argument that the buyback is a quicker hit, which is kind of the idea of it's effectively this kind of dividend that brings in flows, kind of keeps the stock, it gives you this kind of downside, almost protection in a way. Whereas the CapEx, We love to see that, but it might take some more time to pay itself out a little bit. So
Sure.
is that where the depreciation stuff comes in?
Yeah, like right now, everyone's
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile